have the week in review and have a little wrap up of what happened last week, how markets ended, and a look at the week ahead to come. And two of our premium regular guests on a Sunday, Mr. Christoph Ruhl, Senior Research Scholar at the Center on Global Energy Policy at Columbia University, and Adi Imsirovic, Senior Research Fellow at the Oxford Institute for Energy Studies. Thanks again for joining us this morning, gentlemen. Christoph, let me start with you. Let's look at the week in review and how the week ended. Oil was, I suppose, ended up a little bit on Friday in terms of the market close. Looks like supply worries were again sort of winning over demand destruction worries. Would you agree with that?
Yeah, but if so, it would be very temporary fluctuations. I mean, I think what we have is, when we start systematically from the source of all this turbulence, from the war, a situation which is more towards freezing. The Russians are digging in the south. Their attempts at an offensive in the Donetsk basin are becoming smaller and bloodier and bloodier. So it seems that they are sort of in there for the long term, and that's what we observe. And then in the economy, of course, we have the recession fears, and for energy markets, what this means is that their oil prices are caught between the success of possible sanctions, in particular in Europe on the one side, and the fear of a recession, particularly in China, on the other side. And from that perspective, I think what comes out of China now is frightening to some extent. There's the economy clearly on a downward path. The GDP numbers clearly not real anymore. And the leadership clearly posed to execute, everything as if everything was okay, and execute the zero COVID policy until the party congress in November. So that is bad for energy markets. And then the sanctions business, what we saw last week is the G7 meeting, and Adi and I were just talking about it. A lot of detailed proposals from the US and a lot of sort of dragging their feet from the Europeans. And as long as that is the case, we will see that oil prices sort of fluctuate in the current range.
Okay, well, let me go to Adi on the sanctions point, and I'd like to talk about China as well. But on the sanctions, we're inching closer, supposedly, to sort of an EU-wide embargo on Russian oil. But at the same time, and let's combine oil and gas maybe, because gas is the critical one perhaps here as well. You know, what's also showing is that we're getting increasing gray areas between individual countries on what they're doing. Some are getting away and sanctioned to use new rubles accounts, etc. Where are we at, Adi? Is that all kind of weakening a bit, that whole sanctions argument, because of the realities now hitting home, practically speaking?
Morning, Diallo. As Christoph just said, we had a bit of a sort of a pre-recording chat about this. My comment, and I may as well just come out straight. It's a complete mess right now. First of all, there was this G7 meeting that was in Germany, and that was promising a lot because Joe Biden was presented with a very good white paper with further ideas on sanctions, and those ideas were in line with Iranian sanctions that actually work. And they were primarily based on price caps and secondary sort of sanctions. And secondary sanctions are basically sanctions that are outside the US jurisdiction. They also talked about potential additional sort of import taxes or duties on Russian imports. So there were all sorts of ideas there. I thought it was very interesting. I thought something would come out of it. I think the rest of the market did the same, and that's probably one of the reasons why on Friday the market closed a little bit higher. But unfortunately, nothing came out of it whatsoever. Europeans basically put their arms up in the air and said, well, we can't do this. And in terms of sanctions and gas, it's a very similar story in spite of all the recommendations by the European Commission in terms of what this means and how it can be done. There are significant, as Draghi said, Mario Draghi from Italy said, there's significant gray areas in between. And they're probably deliberately left that way in terms of sort of reading how one would deal with Russia. Just to kind of summarize it, the way that the new system of payment in rubles is supposed to work is that, you know, companies that are dealing with Gazprom are supposed to open these, probably the easiest way to explain it, it's not quite literally true, but it's like a multi-currency account that would be including ruble account, and they would pay in euro, then give sort of instructions that money is changed into rubles and effectively then pay in rubles. And this is where this sort of gray area is. Well, if they don't give an instruction and Gazprom Bank automatically converts into ruble, it's not a big deal really, because they're just paying in euros and dollars. But if they do give instructions, does that amount to payment in rubles or not? And that really is a political gray area that could quite easily be sorted out between buyers and sellers. But
I think
it looks like the EU, I mean, for the majority of its members who want this to work, want to continue taking Russian gas, would kind of push for that gray area. And Germany and Italy have them telling companies that they can go ahead and open ruble accounts. Christoph, can you just comment on that as well? But also, just there was an article we had this morning that Germany now, another solution is it's going to auction any Russian gas it gets in because of limitations. You know, how does something like that work? That just easy.
So I think we have, I think we have to be clear about two things. One is this kind of ruble or non-ruble payments is economically, financially, and business-wise makes no difference at all to the previous discussion. This is just introducing a different account and being a nuisance and trying to force the EU to violate the letter of the law of its sanctions by, as Adi explained, these companies dealing indirectly with the central bank. The important thing is that we have a repeated pattern here. We have the big man on top, the Russian president, going out and saying, okay, you pay in rubles or all hell breaks loose, you could be cut off. And then you have a whole layer of bureaucrats and technocrats below it trying to avoid the worst and trying to come up with face-saving, complicated legal constructions to make this possible. And we see this here in the ruble accounts where they introduced that. We see that even in the negotiations about evacuating the steel plant, where underneath it's not so much a gray area. There are people trying sort of to preserve the current situation and preventing it from getting it worse, and that all goes into the direction of freezing it. In other senses, for the sanctions, it's not as bad, I think, as Adi said. There's also a pattern here behind it, which is that historically in oil sanctions, they were always sort of unilateral. They were always mandated from a central perspective, usually the US, and then enforced. Right? So if Germany or France or China didn't buy Iranian oil, they would be confronted with secondary sanctions. This time has been completely different. This time it has been totally unilaterally and decentralized voluntary decisions, country by country, across fuels, has made announcements what they're going to do. So with the UK saying, okay, we can't cut out oil, but we can cut out gas. And Germany saying, we can't cut out gas, but we can cut out oil. And others saying, we did already coal and so on. And so this unilateral, decentralized approach was so far quite successfully, but it will, of course, work only if it continues. The moment the situation is no longer ratcheted up, the pressure is leaving, the system will re-equilibrate, and flows will go to Asia, and the money will continue to flow to Russia. And at this point, the European Union is shooting itself in the foot. They create their own sort of centralized mandated problem by saying we need to have this unanimous decisions, for which the EU is famous. This is like, the Russians fighting a war with Soviet-style army tactics. And that's what the EU is doing. And it's not going anywhere. And that's the real problem. So one has to tell them, let go.
Yeah, and meanwhile, the ruble strengthens and the euro continues to weaken for other reasons as well. Obviously, the whole recessionary fear and the pressure that the continent is under. Adi, let's talk a bit about demand. From China, Christoph mentioned it in his opening comments that there's still concerns about Chinese demand recovery, but at the same time, we saw at the end of last week stronger April import crude figures for China compared to a year ago. A big improvement on the first quarter, maybe expected. Shanghai lockdowns are going to be eased soon, etc. The whole comeback story of China looks like we're at the start of that. And would you see that sort of continuing to support the market?
Well, yes, I guess, we get the data only from the ship tracking data, and we know that countries like China and in India, of course, are very price sensitive. It appears that in May that there has been a quite significant pickup in purchases of Russian crude, particularly two companies like Unipec and Zhenhua. Zhenhua is particularly worrisome, I think, in my opinion, because that's essentially a defense contractor company. Them lifting oil from Russia is kind of rather interesting. And Unipec, I think, is already committed to, or Sinopec on behalf of Sinopec, to lift about 10 ESPO cargoes from the east. So their purchases have jumped quite a bit, over 1 million barrels a day, if the tracking data is to be believed, compared to probably some 700-800 in the last couple of months. Now that we don't know whether that's because of demand increase. There has been some easing of the measures in Shanghai regarding the COVID. But also, I think it's more to do with price sensitivity in terms of the other buyers in China, because simply oil is that cheap. I think ESPO crude on the east, which is Russian crude loading at Cosmino in the east, is pricing about $20-something below Dubai, and normally trades well above Dubai. So that's extremely cheap. And many refiners, including Koreans, Japanese, are not buying it. So obviously China is saying, okay, fine, it's so cheap that we can probably take it. Plus, let's not forget that Chinese storage is fairly available at the moment. So I think they'll pick and choose the opportunities to buy some cheap oil and rebuild their storage when they can. Well, so whether demand is picking up, I'm not so sure. I agree with Christoph, the sort of everything, all the data that we get from China is looking rather bearish still, but the buying has certainly picked up.
And Christoph, and the impact of that is the argument that China is trying to gradually lessen its dependence on crude imports. It can't, it's obviously going to continue to import, but it's trying to do that, and that is obviously directly impacting its products production and export, obviously, which again are hitting the market quite badly. Is it going to play with that at all? China, it has the choice to buy crude today from different sources, but it is self-limiting still.
We have to be clear what's happening there. So China is restocking. China is preparing for worse times to come. What is very clear is the economic and the political picture, and that's deteriorating very fast. I mean, despite all the talk about China bailing the world and oil price out, the economic growth forecasts are now coming in below 4%, 3 point something from the IMF, 4.0 from China itself. That's a sharp decline compared to these 10%, 8% numbers we are all used to over 30 years. And what we are seeing is that it's not only the consequences of the lockdown, it is also the over-leverage and the financial crisis sort of trying to be prevented in the property sector. And it is the political campaign for more egalitarian distribution, which hit the tech sector when, there was really an open propaganda campaign about these companies and their leaders. All of that leading to a decline in investment, and all of that leading to an incredible decline in productivity. As far as we can piece the numbers together, that's not looking good. And on the political side, you have clearly and obviously now the division between the top leadership saying we need the lockdown, it was the right thing to do, and we will continue it, with all sorts of nice phrases, but that's the hard message. And the central bank, the Minister of Finance, the Vice Premier, all saying, oh, this is suffering, the economy is suffering, we need to find a way out of it. And it will be difficult for them to have the right stimulus given the mess in the property sector and in the tech sector already. So long way of saying that oil demand is declining in China. This is not, the higher imports are not driven by stronger economic growth. There's no way for that to be true. So they're restocking, and why? Because of the crisis they're seeing, because of Taiwan, because they can, as Ali said, they have storage capacity, and they have a historical pattern. During the pandemic, they did the same thing. Every time oil is tanking, and now it's tanking big times, 20 to 30%, 30% for seaborne Russian crude discount. And so they go in shopping and feel that it makes perfect sense from their perspective, but it's a flash in the pan as far as the oil price is concerned.
Yeah, and I mean, the other people going shopping are India for Russian crude, but other crudes as well. We had one of our regular speakers on last week who said, yes, we're buying cheap Russian oil if it's offered, but it's only 2% of our daily purchases, so no big deal. But India, unlike China, is still on track for 8% growth this year, according to some estimates. So that picture is looking stronger, Christoph. Just staying with you there, how much support is that going to? Is that sort of compensating for the sort of slightly bleaker China outlook?
No, Indian imports are too small to really compensate for China, but India, China, and the Middle East are the only growth centers we have in global oil demand. I mean, the big picture is that in the OECD, in Japan, in Europe, in the US, everywhere oil demand is in long-term decline. So the tipping point for a temporary, I'm not saying peak oil or something, but a temporary crisis in oil demand would be in these countries, and India is definitely part of that. the other end of that story, of course, continues to be in Europe. If Europe manages, so hypothetically, would just allow countries to go ahead and take them at their word, the Germanys and the Frances and the big importers like Italy, then those complainers like Slovakia, Hungary, and the others at the end of the Druzhba pipeline would be dried up. The pipeline would sort of at some point not have enough to make it worth running, and that would create a problem. But with this European policy of getting everybody on the same page first and then moving very gradually, that also goes in this direction of freezing the situation, which we see everywhere now, this trend. And that is something which was Russia's strategy from the beginning. And they can now basically sort of, I think that's towards what they're working towards, leaning back and waiting for things to slow down and for Europe, the cracks to emerge openly. Yeah. And I'm afraid this might happen.
Yeah, let's talk about Europe and so just the macro economy outlook. Obviously, recession may be happening. The euro has been diving. How much of an impact again are these high product prices, whether it's jet fuel impact on airlines or whether it's the other industrial fuels going into manufacturing? How much impact is that having already on the ground in terms of economic activity? We'll go to Christoph later about Germany. It doesn't seem to be impacting things much there at the moment, but how a European economy is catering to that. The UK obviously is one of them feeling the pinch in terms of inflationary prices across the board.
Well, I think we're focusing too much on Europe when it comes to this energy crisis. I think Europe is probably going to be one part of the world that will be least affected. I think it's the developing world that's really going to suffer because we live in a global market where gas prices are linked to LNG prices and the hub prices. Crude oil market is famously liquid, one great pool. So, when there's a situation like this, all the prices across the globe go up. And people who actually can afford it least are going to suffer. Look at Sri Lanka, for example, and most other developing world as well. Coming back to Europe, I just have to mention, I'm sorry, I'm taking a little step back, Diala, on what we talked about sanctions and me sort of commenting on Europe being a bit of a mess. At the moment, for example, Italy has been importing more Russian oil than they have in at least a couple of years' time, interestingly enough. And these are sort of unintended consequences of various European policies. So because, for example, Lukoil in Italy runs a refinery in Sicily, they have a problem because of all these sanctions to import, to open letters of credit and import other grades. Normally for that refinery, they import relatively little Russian crude. Now they can't do it, so they have no option but to go to the parent company, so they're importing hell of a lot more Russian crude. And similar situation may happen with Rosneft with their refineries in Germany. So, it is still a bit of a mess. So far, it's difficult to say in terms of economic activity. I think we just had this rebound from COVID. We've had massive injection of funds in all the developed world, United States and Europe. And I think that's still keeping the economies doing relatively well. Unemployment, in spite of what you said in the UK, unemployment figures are at record lows. In fact, there is a scramble for talent in the UK at the moment to find the right people, and wages are going up as well as the prices. So it's looking okay. Of course, long term, I think will all be a function of what happens with inflation and whether it's a temporary or permanent phenomenon, on which I'm sure Chris will have more to say.
Yeah, I'm going to get to Christoph on the latest sort of forward outlook for that. But let's just look at that survey question, which is kind of addressing one of the 2 points we've talked about this morning. Crisis, what crisis? Germany's DAX stock market has given up some gains recently, but overall still up. From a long-term perspective, it isn't being hit as hard as one might imagine in the current sort of equity route. EU energy embargo, meanwhile, on Russia is dead as a dodo bird, i.e. not yet biting, strengthening Russia's ruble, if nothing else. So let's get the results on that in 5 minutes, please. Back, Irene. Christoph, let's look at that in terms of forward-looking as well, week ahead. Let's go to the inflation story a bit and the US Fed again. Any sort of figures to look out for? And feeling is perhaps has this inflationary panic now settled into, okay, yeah, we have inflation, but actually we've seen the worst of it? Could that be the case? Has the market, do you think, settled? Equity markets even, are we going to see a turnaround? Or maybe not, just a stability?
You would see inflation inflation not accelerating anymore. So growing faster and faster, which has been the case so far. But that's just a sort of statistical answer. And you probably will see high inflation rates coming down a little bit. But just to remind you, with current interest rates, basically every inflation about zero in Europe, for example, means negative real interest rates and is out of balance. And in the US, interest rates are on the way up very, very clearly, and the ECB will follow. And stock markets reaction, how they cope with that will happen after they have seen what kind of interest rates to expect. So I don't think inflation is over now. It may stop growing so fast, but a permanent rate of like 9% in the UK, 8% in the US, and 7% in Europe is not acceptable. And Europe is always a laggard here because they have very different inflation rates in different countries. The point I wanted to add to what we discussed earlier, which also plays in the economic situation, the shame of these missing sanctions, especially from Europe, is that Europe and the US are much better placed to withstand an oil price shock than the emerging markets, including India and China. So they have higher income levels, so energy expenditures per person are less as a percent of their income. They have lower oil intensity. They have less vulnerabilities in terms of their terms of trade. And they have the whole sophisticated system of storage and of distribution, all of that. So they could much rather afford high oil prices than emerging markets. But what I see coming is really emerging markets be hit by energy prices plus food prices plus inflation in a very bad way. And for the equity markets, what we are seeing now is that the world is sort of waiting for a catalyst. It could be that there's some big bust up in crypto, could be something in emerging markets, or it could trot along a little bit. If it trots along a little bit, then there's a chance that they get used to higher interest rate and the situation will lead to a soft landing. But the odds are probably lower than 50%.
And I mean, how much of the current oil price that we're seeing today would you say is still Russia, Ukraine war premium, whether it's fundamentals or not, or whether it's just sentiment? But a lot of people are saying it's still about $20 to $25. Would you agree with that, putting fundamentals aside?
Yeah, you can never specify how much the risk premium is for you, but I would think that we would, without the war, be still in the same range we were before, like the 80s, somewhere plus minus 5. And that seems to be, the upper end of an oil price in an undisturbed world. If peace were to return to Libya, Nigeria, Iran, Venezuela, all the conflicts would be settled. The world has more than enough oil than for oil prices to come down to very much more sensible levels. But this is unlikely to happen because the next crisis will certainly be just around the corner.
Okay, well, let's look at that survey before. And Christoph, I know that you have to go in a couple of minutes. Let's look at that. Agree quite definitively, 75%. That's kind of a positive outlook in a sense, not for the markets, but i.e. positive that oil will continue to flow and industrial activity is going to keep going. Christoph, let's just get your thoughts on the German DAX, as it's in our survey question. Performing relatively stable, well, compared to what we've seen at, NASDAQ, for example, or even the S&P in America, despite the fact that, Germany is supposedly under current energy crunch crisis. How do you interpret that?
I think the German economy is very strong, has been growing very strong, came out of COVID very strong. It mirrors Europe in many things. And it has one central weakness, to be brief, and that's that they are export dependent. So the moment this deglobalization trends continue, this is the same weakness China has. And they are cut off from the export markets in Asia and have to cope with this shock in Eastern Europe and so. And when then America sort of goes into a slowdown, then they will be in trouble. But internally, from consumption demand, so that's all okay. But they still can't get a plumber, despite the Ukrainian refugees.
Okay, well, thank you.
But it's the external side which is the problem.
Okay, thanks, Christoph. I know you have to switch off soon. Thank you for joining us.
Okay, thank you.
We'll look forward to seeing you next week. Ad, just to go back to you on that front, you were mentioning in Europe that employment is still healthy. There's still wage, not inflation, but increases. As Christoph just said, lack of sort of labor supply for certain skill sets. Where are we at with the sort of whole global supply chain crunch situation, which of course is nothing new, started during COVID, and of course now is feeding into this inflationary argument even more. Are we seeing any easing of that anytime soon, because COVID has eased, and in terms of shipping, etc., and everything that feeds into that?
Well, there has been some easing off as far as supplies within sort of European Union and the UK are concerned. But of course, the real thing is China, because most of the sort of supply chain comes from China, and we know the situation is still pretty bad over there. So I think the situation is overall not much better in that respect. So Europe, I totally agree with Christoph. I think Europe is not doing particularly badly in this situation, simply because it's a wealthy part of the world. It has very good economic policies as well as energy policies. I think that, just taking a little step back on what you're saying, I also agree with him on the fact that, yes, the markets are very, very tight. The oil prices are likely to remain high and elevated. But we do have, OPEC does have at least 3 million barrels of excess capacity right now. And I think some of the worst scenarios that I've seen were that they would lose about 3 million barrels of Russian crude. So if you look at that there can be evened out fairly and squarely. And if you add to that about 1 million barrels a day of SPR that has been released recently, I think that there is a fair amount of oil out there available. In terms of just going back a little bit to supply chains as well, I think what also we've noticed in sort of jet fuel market, even though the sort of travel restrictions are still quite there, particularly in Asia and China, there's been a big increase in demand for jet fuel. And one of the reasons for that has been actually freight demand. A lot of these bottlenecks have been resolved. In many cases, even auto parts have been imported by air rather than by ship. So air freight is going through the roof, and demand for air freight is extremely strong.
And I wanted to actually ask you about jet fuel in particular, with the travel demand in Europe, trying to book tickets, as we see that's all you can see the jet fuel price and demand in general feeding into ticket prices on that front, and certainly no slowdown there, it seems. But on the emerging markets front, how are we going to see that? They're going to be obviously suffering the most. You brought it up, Christoph backed you up on that clearly in terms of debt, dollar-denominated debt, commodities being bought. Again, commodities across the board. What's your outlook for that? Not just oil, but other grains, etc. This war looks like it's going to drag on for a few months more, one way or another. So again, that the inflationary impact on commodities, would you be as positive as some others are, that that's going to continue to be a very positive story?
Well, one thing we can say for certain is that it's going to be volatile. Most of the current problems that we are seeing in the commodity markets, particularly in the oil and gas markets, is just purely political problem. It's the war and anything that goes around the war. So it's very hard to predict unless we know what is going to happen in terms of war. Most likely, it seems to be sort of grinding down to a bit of a halt, with Ukraine being stronger with all the Western weapons, slowing down Russian advance, and Russia losing interest in moving any harder because they've suffered immense losses themselves. So within a few months, we are likely to grind to a halt. And at the end of the day, there will have to be some political settlement. So whether that happens or not is really going to influence the sort of commodities world, i.e. grains, oil and gas. Now, one thing that I have to mention that we haven't mentioned so far in our discussion is that the high interest rates are not good for commodities. Interest rates are definitely going up. The predictions for the next Fed hike is 0.75% rather than 0.5%. So these are big increases in spite of a high inflation, in spite of the fact that it's the real interest rates are still negative. I think that those are big hikes, and that's why we are talking about developing world dollar-denominated debt being a real problem. Anyone who's got debt will still have to pay high interest rates, whether real interest rates are negative or not. So and that's high interest rates are not good for commodities either, because it's all to do with theory of storage. You have to once you store commodity, they don't yield anything other than capital gains. So unless you count on their capital gains, high interest rates are just much higher cost. So that it's going to be a big break on the commodity prices, and I think we will be seeing that.
And just before we go, Adi, just to get your thought, you mentioned OPEC. We didn't really want to get into it too much today because nothing seems to be budging there. You know, if one believes the oil price is going to remain capped at 110, it looks like OPEC's going to do nothing. What would it, you know, when would they use any extra capacity they have, do you think? At what price would trigger that, if anything?
Well, I don't think it's a question of price whatsoever. Again, this is, as I said, when I said this is the whole situation is a very political problem. That includes the situation with OPEC. I think it's all to do with the relationship between Saudi Arabia and the United States. I think that what would take is a phone call and a serious discussion regarding the Saudi security, particularly in terms of the situation in Yemen and many other issues. And I'm not quite positive that can be resolved overnight, especially with the attitude of the Biden administration towards the de facto ruler MBS. So that's a very, very political situation. And I think Saudis can very, very quickly increase their output by 1 million barrels and ease off the situation. But they're not doing it, and clearly they're not doing it for their own reasons, and those reasons are clearly very, very political.
Yeah. Okay. Well, and then of course Biden did host the ruler's brother recently in the last few days, and we'll see what came out of those conversations in reality. But thank you so much, Adi Imzirovic, for joining us this morning. Thank you to Christoph earlier, and have a great week ahead.
You're most welcome.
Thanks.
Bye.
Well.